Our last video finished up at step 3, and we did not have a chance to get through our third component, our third consideration of step 3. Remember, step 3, determine the transaction price. We discussed accounting for variable consideration. We discussed time value of money when there's a financing component to a transaction. And last, we're going to finish up with consideration payable. Fairly straightforward topic. Did not fit in my last video. Okay, so the third component of our revenue recognition steps, consideration payable. So remember, consideration is the amount you receive when you sell a good or service. We're typically referring to, when we say consideration, we're typically referring to cash. Why would cash be paid when we're making a sale? We're talking about rebates, coupons, and discounts, stuff that's going to reduce the amount of cash that we receive. And so for reducing the amount of cash, what should we do? We should reduce the amount of revenue. Reduce the amount of revenue related to those rebates, coupons, or discounts to the consideration payable. Okay, let's look at our last example from our class examples. These are our revenue class examples. Example 6. Samsung Company offers its customers a 3% volume discount if they purchase at least $2 million of its product during the calendar year. On March 31st, 2019, Samsung had made sales of $700,000 to Arctic Company. All right, so we're trying to figure out on March 31st, when the company makes these sales, should it expect to record the full $700,000? Should we expect that the customer, Arctic, will not take advantage of the discount? Or should the company expect that the discount will be taken and therefore we should only recognize 97% of the $700,000 sale? Well, we need to make an estimate about whether or not the customer, Arctic, is going to fulfill that full $2 million worth of sales. That's why we have the information in the next sentence. In the previous 2 years, Samsung sold over $3 million to Arctic, so it's safe to say that this customer is going to purchase at least $2 million and will get the discount. Therefore, when we record this sale on March 31st, we should record it net of the discount. There's no cash here. We have accounts receivable. And accounts receivable should be reduced by the amount of the expected discount. So we are only going to record 97%. Or 100% less the 3% discount. Accounts receivable is increased by $679,000, and we're going to increase revenue by $679,000.